welcome to our special programme on the US Jobs Report with me, Victoria Scholar. We're live on the IG platform, on YouTube, on Facebook and on Periscope. Now we've got just under 5 minutes to go until the data release, so let's give you a quick roundup of what we're expecting. July's non-farm payrolls report is expected to come in at 193,000. According to 74 economists polled by Bloomberg, the range is between 165 and 257,000. We'll also be watching out for any revisions to last month's reading, which hit 213,000. Now, July's unemployment rate is forecast to improve to 3.9% from 4% in June, and that all-important average hourly earnings figure is seen holding steady year on year, coming in at 2.7%. Meanwhile, wages are expected to increase slightly to 0.3% growth from 0.2% last month. Now, let's have a quick check on how European markets are trading ahead of the release. I think the major European bourses are trading higher as we pass the session's halfway mark, driven by strong earnings. RBS is among the outperformers on the FTSE as investors cheer the announcement of its first dividend in a decade since the government bailout in 2008. As you can see there, the FTSE 100 trading north by 0.8%. The DAX not far behind, clinging on to 0.63%, and the France 40 cash up by 0.25% as we currently stand. Now let's have a look at the state of trade across the Atlantic as US markets warm up on the IG platform, preparing for the start of the session in just over an hour's time. And as we can see, it's positive prints just about across the board, with the Nasdaq leading the charge up by 0.21%. Now, over in Asia, it was a rather negative session. The Chinese stock markets led the declines amid ongoing US-Sino trade tensions, and that also weighed on the renminbi, which slumped to a one-year low. Switching to Forex, here's how the major currency pairs are trading on the IG platform. If we can take a quick look, the dollar was coming under a bit of pressure last time I looked. Euro dollar currently trading at 115.60, but of course a lot of market participants taking to the sidelines ahead of that key jobs report, which we'll get in just a few minutes' time. As we can see there, euro dollar up just by 0.02%, really clinging on to minimal gains there. Cable absolutely flat. Joining me now for a quick first word as we await those all-important numbers is Callum Pickering, senior economist at Berenberg, and IG analyst Josh Mahoney. Callum, if we start with you, we had that Q2 GDP reading in the US last week, which came in ahead of expectations. It was the strongest level since Q3 2014. Then on Wednesday, we had that ADP private employment report, also topping estimates. So it really looks like the US economy is firing on all cylinders as we currently stand. So I'm wondering whether that sets us up for a beat today.
There's a good chance we get a beat to the upside. Demand in the US is very strong, largely because of the fiscal stimulus, but global demand is helping too. This is a key piece of data from a macro point of view, insofar as it tells us how long the US economy has left in the upswing. If you get good jobs numbers, but relatively weak wage growth, that suggests that lots of supply left that the US economy can absorb. If jobs growth slows and wage growth starts to pick up, then markets might start to think that this upswing is looking quite mature.
So it's normally the headline figure that has the biggest market impact in the short term, but let's remember back in February when we had that strong average hourly earnings for the month of January, that's what sparked the initial sell-off. So I'm wondering which part of the report is most important to you?
The wage data is important insofar as the Federal Reserve is gradually tightening US monetary policy. Now, the Fed can go slow so long as wage and inflation pressure edges up slowly. If wage growth beats to the upside, markets may start to think that the fiscal stimulus is creating excess demand in the US, and eventually the Fed could be forced into a situation where, say, it has to create some unemployment in order to meet its inflation target. So a gradual edging up of the wage growth data shows that the Fed can go slowly.
All right, well, let's recap the numbers once more before we bring you the data release in just over half a minute's time. We're looking for 193,000. That's for the July headline non-farm payrolls figure. We'll also be watching out for any revisions from last month's reading, which came in at 213,000. Now, the unemployment rate is seen improving to 3.9% from 4% in June, and average hourly earnings are expected to hit 0.3% month on month, or 2.7 0.9% year on year. Now, euro-dollar is trading pretty much flat as we await those numbers. Now, let's see if we can get those numbers for you. It's 193 for the expectations, and it's 157, so a miss on consensus for the headline figure on non-farm payrolls. Average hourly earnings came in bang in line with expectations, 2.7% year on year, 0.3% month on month. And if we look for the unemployment rate, that's 3.9%. That's again in line with expectations. So everything in line apart from the headline non-farm payrolls figure for the month of July, which came in at 157,000. That's a miss versus expectations to 193,000. Meanwhile, last month's reading was revised higher to 248,000. So let's just have a quick check on the markets. We can see the dollar really coming under some pressure here. Euro-dollar spiking a bit on the miss on the headline number. But it is important to still remember that the last month's reading, which is potentially a bit more reliable, has actually beaten. So it's a bit of a mixed bag, I'd say. Callum, what's your initial thoughts?
At this stage in the cycle, you would expect employment gains to slow down a little. The US has very low unemployment, so anything above 150,000 on the jobs data is pretty good. I think as a macroeconomist, I'm fairly relieved that the US wage data hasn't surprised on the upside. It means that we don't have to think about the US Fed upping the pace of rate hikes in the second half of this year and into 2019.
So perhaps that allays a few concerns about inflationary pressures, the fact that wages haven't beaten expectations here.
Correct. I mean, if you think about the fiscal and supply side policy that the Trump administration has introduced, half of it, a good half, is just the simple fiscal stimulus where you borrow money and support demand. The other half, the rolling back of regulations, the simplification of the tax code, that can raise US potential supply. So if the demand side component is matched by higher supply, and that would be expressed in a very gradual uptick in wage and price inflation, that is pretty good news, and that seems to be the way the data is showing the output of this policy.
Now let's bring Josh into the conversation for a bit of technical analysis. Now the euro-dollar has been under pressure. It's been trading around 5-week lows. What are the technicals suggesting on the pair right now?
Yeah, I think it's been a really interesting time, actually. I mean, look, we've been in consolidation mode for a number of weeks now, so the expectation is, given the sell-off that we saw coming into it, are we going to see that next leg lower coming into play? Earlier in the day, we were seeing a lot of weakness for euro-dollar. Of course, now we're seeing the pair actually seeing in the green for the day. So the question mark over whether we're going to see this sort of double top formation. Ordinarily, you'd like to see that at the top of a trend. Nevertheless, you can see, of course, that failure to regain the previous high and the break of the neckline would allude to a potential next move towards the downside. We're looking in terms of the shorter term, though. We can see this move higher. Of course, the crucial thing, like you were alluding to earlier, you always see sort of different stages within movements post NFP number. Generally, markets move to the payrolls numbers first, then they start reacting to some of the underlying data. I wouldn't necessarily say that there's much in the underlyings that point towards anything other than the headline number. I'd say participation rate, the fact that that didn't tick higher as expected, that would have been a strong factor if we had seen that start to move higher. Of course, you'd like to see that move towards a consensus of some of the other developed nations that have a much higher rate of participation rate. In terms of this bounce that we have seen coming into play the last hour and a bit, the question mark is, have we broken or have we not broken out of this triangle that we see on the 4-hour chart? We've seen this break of the triangle, but we didn't break through your major swing high on the way up. On the way down, we tried to break this 115.75. Now it looks like we could be faltering. We could be remaining within what essentially looks like near enough a range that we've seen in play for the last couple of weeks.
And let's look at the safe haven gold asset as well, because it's come under significant pressure since April, down some 10%. So that's pretty much in correction territory there. And the question is, are we near the lows?
Yeah, certainly. And so we've seen a breakout from a trend that has been in place since the lows in the back end of 2015. And that is that we continue to create, on this wider perspective you can see on a weekly time frame, the creation of higher lows, despite the fact that we pretty much failed to create new highs with the breakthrough 1357 up to 75. We kept knocking on that door but failing to actually break through it. Well, ultimately, it had to break one way or another, and it's broken towards the downside. So that break below 1236 gives us the double top formation and points towards further downside to come. Of course, we'd like to see further dollar strength for that move to be coming into play The weakness that we've been seeing in terms of the dollar has given us a bounce. You can see this. This is actually a continuation of what we've been seeing so far anyway. So if we look at the 4-hour chart, what we can see is this essentially looks like a part of that move anyway, right? So we saw the sell-off and the drop out from this period of consolidation following the break through the neckline at 12.36. The rally we're seeing at the moment looks like it could be coming into potentially some sort of trendline resistance, but you're going to be looking out for your major swing highs. 12.28 is going to be interesting, but the big number is going to be 12.35, that previous peak, and 12.36. As long as you don't break through that level, I think the rebound we're seeing at the moment is probably a good opportunity to get short.
Now let's bring the conversation back to the macro picture for a second. Callum, we heard from the Fed this week. Clearly it was an upbeat assessment on the overall US economy, despite not raising rates. They're clearly signposting that September and December look like they could be live. Is there anything in today's report that could change the pace of tightening from the Fed?
No, I don't think so. Two hikes this year, very gradual, probably one per quarter pace next year. The key issue for the Fed is how much of the economic policy, fiscal stimulus and global demand translate into extra inflation, extra wage growth. For now, these pressures look modest. The US is in a long cycle. Typically, the expansion phase is about 7 years before you get a recession. We're now heading into the 9th year. The key point is that economic upswings do not die of old age. They die because excesses build up to such an extent that a corrective recession is required. If I look across major parts of the US, I don't see excesses in credit, excesses in production, investment, wages, or inflation. So for now, the Fed can continue to go very, very slowly. Broader point about the dollar, it's a slightly unusual currency from a macroeconomic point of view insofar as it captures the risk-on, risk-off appetite in global markets. Notice 2017, US GDP growth accelerating strongly, the Fed hiking interest rates. That trend has continued in 2018, but whereas 2017 the dollar was weakening, 2018 the dollar has been strengthening. So it's less driven by economic fundamentals in the US, more driven by risk appetites in the global economy. And of course the big difference in 2018 is we're all worried about trade wars, which means that risk on investors become risk off investors and they go towards the safe haven of the dollar, even though it is the president of the US which is triggering all these fears in the first place.
And if we take a step back and look at monetary policy across the globe, we're still seeing ultra low rates from some of the key central banks like Europe and Japan, and even in England, in the UK, we're only at 0.75%. So it's only really the Fed that's tightening right now. Are you surprised by that, given the fact that we're a decade on from the financial crisis?
Not really. The post-Lehman period has been characterized by an unprecedented age of caution in which risk appetites for investment, for credit have been much weaker than before, which means the relative interest rates that balance the economy are much lower. I'd hesitate to say that the US is really seeing a tightening from the Fed. It's more like a normalization. The key point about there being no excesses in the US can be extended to the broader advanced world. What we're seeing is one by one, central banks estimate what they think is the neutral rate. So the Fed has its neutral rate at around 2.8%. Yesterday, the Bank of England gave us a first estimate of the neutral rate, somewhere between 2 to 3%, let's say 2.5%. That means that both in the US and the UK, monetary policy is not yet at the level which would lead to a contraction in demand. We're still way away from that. So for the next 1 to 2 years, expect monetary policy to gradually normalize, but not really dampen demand in any parts of the Western world in any major way.
All right, well, before letting you go, let's have a quick last check on equity markets as we conclude our special monthly program on the US jobs report. Let's have a look at Forex first. Euro-dollar is up by 0.18%. On the back of that miss on the headline non-farm payrolls figure, the dollar weakening there. Similar situation with cable trading up by 0.8%, which is indicating weakness for the greenback. And once again, a similar trend with dollar yen. If we can have a quick look at equity markets in Europe, this is how we stand. FTSE 100 still outperforming, up by 0.8%. And stateside, let's see how trade is shaping up with around 50 minutes to go now until the start of the session. The Wall Street cash there flat, the US 500 cash also pretty much flat. The Nasdaq outperforming, up by 0.15%. And remember, Apple yesterday became one of the first companies to hit that $1 trillion valuation landmark, that likely boosting the tech sector there. Now let's have a quick last recap of the numbers before letting you go. It was 157,000 on the headline number. That was a beat on consensus. Meanwhile, last month's revision was moved higher to 248,000. The average hourly earnings came in line with forecasts, and similarly for unemployment. Thanks so much to my guests, Callum Pickering from Berenberg and IG analyst Josh Mahoney. Thanks so much for watching IG's non-farm payroll special monthly broadcast. I'm Victoria Scholar, and we'll see you very soon.